Ladies and gentlemen, if you will please take your seats, our program is about to begin. Ladies and gentlemen, please welcome Hilda Martin, Principal of Revista.
Good morning. It's so wonderful to be here at the third annual Revista conference. I swear it feels like yesterday and at the same time a really long time ago that Mike, Elisa, and I were huddled in coffee shops talking about how to start this business. We used to have happy hours that we would call creative sessions because after a cocktail or two we'd come up with the best ideas. A lot of these creative sessions early on were about the name of the company. This was such a loaded discussion because we all had such strong feelings on what our company would be named. One night after a few drinks, we said, oh, the mob scene. How cool would that be? But then, the next day we're like, well, that's a little bit much for the company name. So a lot of you will know our blog and our newsletter is called The Mob Scene. We threw around a lot of acronyms, and eventually we came up with one that we all felt great about. Like, yes, this is it. And it was CRE Vista, Crevista. And we moved forward with this. In fact, the other day I looked at a Comcast bill coming in, and it was attention Crevista. A few weeks passed, and Elisa's sister said, the name Crevista sure sounds a lot like the word crevice. And we sat there and we thought, ooh, yeah, maybe we don't want to do that. And then we were thinking, oh, back to the drawing board. But then we just dropped the C. We thought, well, there you go. That's it, Revista. And that's how our name came to be. That first year, we spent so much time, pre-dawn hours till late in the evening, building the first database of healthcare properties. It was completely reinventing the wheel. We had to go from so many different sources. We had several 100,000 properties that we started out with a team of researchers that would look up each one and figure out, all right, is this a purely healthcare property? Is it affiliated with a hospital or a system? How big is it? Who owns it? Where is it? All of those details. And a year later, we had basically what our playground is, our arena. Stats here are updated as of the middle of this year. We tracked everything, so we weren't just looking at major markets, we're looking at any healthcare building across the United States, the continental US. And for our purposes of today, we're just going to be talking about mainly MOBs, but I've got hospitals up here as well. And when we say MOB, it's a very generic term. We're covering basically anything that's outpatient. So this could have an urgent care center, it could have a dialysis center, could be a freestanding ER, it could be your basic physician office building. Anything that's outpatient will fall into that MOB category. So what we ended up with was about 37,000 MOBs and about 5,600 hospitals. It's about 3 billion square feet of space across the US, 1.6 for hospitals, 1.4 for MOBs. And if we assign a value to each square foot in the database, that puts us at right around 959 billion in value for healthcare real estate across the US. Just coming up there on 1 trillion. So today, I wanted to talk a little bit about the overview stats, but I don't want to focus on it too much because I want to dig into 3 trends that we've been seeing over the last few quarters. But let's start off with just some overview stats. On an ongoing basis, from that base property database that we built, we're tracking who's buying and selling properties, who's building them. We're also doing a data collection with owners. So we've got some good statistics going back on portfolio performance. But what you're looking at here is transaction volume just for MOBs. So pretty much everything going forward is just outpatient. The top in green is a trailing 12-month basis, so we can even out some lumps, and the bottom is each static quarter. So in the second quarter of this year, 1.8 billion traded. Q2 to Q2 last year, it was 7.8 billion. So you can see off of 2015, we've got a little bit of a leveling out here. We're coming off some peaks. We had a few really big quarters, end of 2014, beginning of 2015. And it's sort of coming down off of that as far as totals. In the total of 2015, just to give you an idea of how much this is, about 2.2% of inventory traded. We'll come back to that later. At the end, I've got a few metros, and you can sort of compare to the national stats. For construction, we're tracking anything that's in late planning or that has broken ground. Our entire database of all healthcare properties, including hospitals, MOBs, office buildings that have a lot of medical and so forth, we're over 100 billion in total construction value. That was a new number we just hit in the second quarter. But for the purpose of just MOBs and to look at what's being delivered, this is showing you the total square feet per year. That's the top in orange. And completed as a percentage of inventory on the bottom. So you can see deliveries have been increasing steadily. There's a lot of reasons for this. We're always talking about the ACA and how many more people are insured. And the people that are being insured additionally, we're hearing that they're sicker. Demographically, you've got an aging population, and as you get older, you're using healthcare services more. So when you're using all these services more, we're going to need more space to deliver that care, and it's coming online, as you can see here. So 22.1 million square feet have either already been delivered or will be delivered in 2016, about 1.7% of inventory. If we look at that on a quarterly basis, you can see there's a couple big quarters coming up. A lot of that inventory is being delivered just October through December of this year. It's 7.8 million square feet, and another big quarter coming up Q2 next year. So as I mentioned, we have a data collection effort from a number of the large owners, and this is nice because it gives us a view further back than just 2014, because a lot of our stats since we started in 2014, that's sort of where they stop. But these go all the way back to 2008, 2009, so we get a good long-term view. In terms of occupancy, we're always talking about how stable our sector is. We have longer lease terms. You don't seem to see physicians moving around as much as occupants in other sectors. And the proof is really in the pudding. Long-term occupancy has been pretty stable in our sector. In the most current quarter, it's 92.5%. And this is representative of almost 200 million square feet of space. NOI is growing. This is a weighted average per occupied square foot, and you can see long-term steady growth in terms of NOI. And on a same-store basis, that's about 3%. In the current quarter, that's $20 per average occupied square foot. So those are some of the overview stats. Now let's dig into just 3 trends that are starting to come up over the last few quarters. And this is going to be a discussion that will likely be going on throughout today, including the panel coming up after this. The most expensive deals are highly competitive. When we take a look at cap rates, if you look at the top line here, this is the overall trailing 12-month average. You can see it's pretty stable, right around that 6.7, 6.8 mark for the last year and a half. But if you unpack that a little bit, you look at just the deals with the lowest cap rates on average. The end of last year, we're at 5.2. In the most recent quarter, it's 4.6. So we're seeing a compression in those cap rates, which is suggesting you've got more parties coming in bidding on the same deals. It's becoming more competitive for those top-tier properties and portfolios. This plays out again when you look at pricing, price per square foot. In the gray, you're looking at the overall average, which is actually off peak from last year, just a little bit, 7%, but it's a little bit down. When you look at the most expensive deals, that's continuing to rise, the price per square foot, which again speaks to that competitiveness with those top-tier deals. Good example, the Archway Medical Plaza sold at the very end of last year. Beautiful building. It's in Beverly Hills. It's purchased by UBS for $75 million. And at a little under 50,000 square feet, that put the price per square foot over $1,500. So quite a large amount. And you can go back and see that certainly spiked the end of the average for the end of the year last year. Second trend is private equity is becoming a bigger player. So if we look at everything that's being bought and sold, and this is annual here, the orange is private equity, and each one of these is looking at the total volume and the amount of it that was purchased by private equity, so that type of buyer. In 2013 and 2014, it's 26, 21%. For 2015, that went to 39%, and in this year, so far, 43% of the activity has been purchased by private equity. So you can see that increasing. Just looking at that one buyer group, and this again is the trailing 12 months, beginning of 2015, they were buying about $1 billion. You fast forward to Q2 this year, over the past year, they've bought almost $5 billion. So quite a significant increase there. Another way of looking at this, just pull back out for a second. This chart is showing, this pie is showing all of inventory and the ownership makeup of that inventory. So the light blue is hospital and health systems, which is the majority. 25% in green is providers, 10% REITs, 8% private equity. But to look forward, we want to see how that pie is changing. And to see how that pie is changing, took a look at each buyer group and looked at how much they were buying versus how much they were selling and what's the net figure. So in the middle here is 0. Anything below that is a net seller. Anything above that is a net buyer. So the only net buyer as of recently has been the REIT group. So over annualized, it's 2 to 4 billion additional that they're owning of that pie that we just looked at. Interestingly, private equity and hospital and health systems are owning less and less of that pie. So hospital health systems, yeah, that's the idea. We'd like you to own less of that pie. But that's not necessarily the case for private equity, especially when we're seeing that they're putting more and more into the sector in terms of buying. But they're still a net seller as of the second quarter of this year, although that is coming closer to 0. But their section's still reducing in that pie. Another example deal, First Hill Medical Pavilion. This was in the Seattle market in January of this year, relatively new development. Beautiful building purchased by the Heitman NextCore JV. $199 million for a single building, and it's $884 per square foot. Beautiful building. So last but not least, the third trend is the on and off campus assets and how that divide is beginning to close. And we hear this over and over again about the retailization of healthcare and how you want to move out into the community and how many reasons there are to do this. You've got hospitals and health systems acquiring physician practices. And if you've got this specialty, this specialty, this specialty in different buildings, a lot of times you want to move them under the same roof and put your branding on it. You want to increase market share and get out there away from your hospital hub. You've also got you want to make space for the higher dollar cases on your hospital campus and move the lower ones to a lower cost environment, so moving them off of the campus. With all these reasons why demand would be higher for an off-campus building, we are certainly seeing that in terms of pricing and cap rates. This is splitting the cap rate information for off-campus versus on-campus. So the blue is your off-campus deals, and the orange is your on-campus deals. You see that divide in 2014, and you can see it slowly beginning to shrink as the off-campus deals, their cap rates are compressing, and the on-campus deals, they're increasing slightly. So the difference is 6.8 versus 6.6 in the most recent quarter. If we pulled out all of the smaller buildings, so we only looked at ones that were more than 50,000 square feet, that gap closes entirely at 6.6%. So just a few metros before we move on. These metros are sorted by the amount of trades versus their inventory. So we looked at the beginning overall nationally in 2015, roughly 2.2% traded. In Houston in the last year, 7.5% traded versus their inventory. So more than 3 times the amount relative to inventory. Not a whole lot of construction for outpatient. Some buildings opened recently, but as of right now, not a lot under construction. I added square foot per capita, so that's the amount of MOB space per population, just to give a barometer of what's already in the market. If you take a look at Phoenix, a lot of activity there too, 7.1% versus inventory. A lot of construction there as well. We've got over 5% outpatient under construction versus inventory in Phoenix. Seattle, where that First Hill Medical Pavilion was, 5.8% traded, another market of interest. Not a lot of construction there either, at the 0.4%. So just interesting to see where the focus has been over the last year. So we went over the 3 trends, how very competitive those top tier deals are, how private equity is spending more and more, becoming more of the buyer makeup. And then thirdly, how the divide between on and off campus is closing. We're going to move on to the capital markets executive panel. Before we do that, I just had one announcement. We're pleased to announce that we are partnering with Healthcare Real Estate Insights to do the first healthcare real estate developer survey. This survey is really going to help us get a comprehensive view into third-party development. If you'd like more information on that, you can go to the data center or talk to Mike Hargrave. All of the presentations, including this one, are available on our mobile site, so you can go there and get to any of these presentations that you're seeing today. And now what we're going to do is take a few minutes to set up for the capital markets panel, which will be moderated by Jeff Langbaum, who is a senior REIT analyst at Bloomberg Intelligence. So be patient with us for just a few minutes. We're going to get set up.
Ladies and gentlemen, if you'll take your seats, our program is about to begin. Ladies and gentlemen, Mr. Jeff Langbaum.
Thank you. Thank you, and good morning. My name is Jeff Langbaum. I'm the Senior REIT Analyst at Bloomberg Intelligence, which is a research division within Bloomberg LP. It's my pleasure to moderate this morning's panel on capital markets. We've put together a terrific panel to discuss this topic. A lot of what we're going to discuss is really to bring out more detail about what Hilda was just speaking about. We've got players from all sides of the capital markets. We've got investors, we've got owners, we've got brokers, we've got lenders, we've got bankers. And for the next 75 minutes, they're going to provide an insider's view on the current state of the medical real estate capital markets and hopefully some forward perspective as well. First, I'll introduce the panelists. And I don't have these in order, so let's see. We'll start with Chris Merrill down on the left. Chris is the co-founder, president, and CEO of Harrison Street Real Estate, a real estate private equity firm which he co-founded in 2005, which has completed over $14 billion in transactional volume and currently has over $10 billion in assets under management. To his right, Jeff Tyler is Executive Vice President and Chief Financial Officer of Physicians Realty Trust, where he's been since 2014. Physicians Realty is a REIT with 9.6 million square feet of medical office buildings and a total investment value of $2.5 billion. Prior to joining Physicians Realty, Jeff was a REIT analyst at Green Street, and before that, a real estate banker at Lehman and B of A. To my immediate left, Mark Engstrom is Executive Vice President of Acquisitions for Healthcare Trust of America, where he's served since 2009. HTA is also a REIT, which owns 17 million square feet of medical office buildings and an investment of about $4 billion. Prior to HTA, Mark was Chief Executive Officer of Insight Medical Properties. To my right, to my immediate right, Peter Scott is Managing Director in the Real Estate Investment Banking Group at Barclays, responsible for providing advisory services, raising debt and equity capital for public and private real estate companies, including those within the healthcare sector. He's been involved in transactions for healthcare REITs, including Welltower, HCP, Medical Properties Trust, Sabra Healthcare REIT, Care Trust REIT, and Healthcare Realty Trust. To his right, Randy Williamson, Managing Director with Eastdil Secured Wells Fargo. In this role, he has completed over $20 billion of strategic transactions for both public REITs and private operating companies, including M&A, portfolio sales, joint ventures, in addition to helping raising equity and debt capital. And finally, last but not least, Jim Seymour is Senior Managing Director for Capital One Healthcare, where he leads the healthcare real estate business, providing debt financing for the senior housing, skilled nursing, and medical office sectors. Currently about $8 billion in financing commitments. Prior, Jim led the business development M&A team for GE Capital Americas. Now that we've gotten all the introductions out of the way, what I wanted to do first was kind of go through some of the slides that we just saw and just kind of show you what the key points that we're going to try and dive in and flush out a little bit more. So let's see if I can get this to work. So first, the transaction volumes. One of the points that was made before is that volumes are lower this year than last. So what we want to do is try and figure out why that is and why the players on the stage here, what their view might be into why that is and what it might look like going forward. One of the potential reasons it might be is pricing. So, well, that's despite the fact that NOI is growing. So, you know, I got these out of order on my sheet here. So, you know, NOI is growing, cash flow is growing, should spark interest. Perhaps pricing is keeping people out. And I still got these in the wrong order on my sheet here. Again, we talked about private equity versus REITs. We've got both sides of that table here, so we're going to be able to talk about that. And now we get to pricing. We see the cap rates falling, especially at the higher end. Who's buying what? What are they looking for? Who's making money on a 4.6% cap rate? And then also the convergence between on-campus and off-campus and what the strategies look like. So with that, I'm going to dive right in. And what I wanted to do was start with Randy first, because he still is in the middle of many of these transactions. So maybe from your perspective, can you give us a backdrop of what the buyers and sellers are thinking, what they're looking at, how they're viewing the sector, and what's changed from last year?
Sure. I think many of the buyers and sellers that we deal with are appropriately long-term investors, and they take a very long-term view. I think it's awfully difficult to be a market timer in this market or any. Case in point, October of last year, one of the more respected real estate independent sell-side shops, Green Street Advisors, put out a piece that suggested they were in the ninth inning of the current real estate bull market. And they had ascribed a 70% probability that commercial real estate values would be down across the board 5 to 7% in the next year. Fast forward to this year, values have largely held in check. We have absorbed, at least at the start of the year, the prospects of a rising rate environment. We absorbed a decline in REIT valuations in the beginning of the year, Brexit fears that they'd be contagion, some other issues in the marketplace, and yet we still see values that are at or above, in many cases, valuations in the last 12 to 18 months. And so we think from a long-term perspective, the medical office building space provides a pretty compelling relative valuation or return for investors. So if you start with the MOB, a well-located MOB asset, you've got a 6% going in cap rate by and large, as the data suggested. You've got very minimal capex in most cases. Then you add to that 2.5% to 3% annual rent bumps based on most leases in the space. And those are from tenants that want to stay in your buildings, and they have a strong desire to stay in those buildings. And so that creates an unlevered returns that are very attractive on a relative basis. Then you look at historical debt costs that are lower than they've been at any point in time. And so you can pretty quickly get to mid-teens to low teens to mid-teens kind of levered returns depending on your risk tolerance. And we think going forward that is a very compelling dynamic, particularly when you look at demographic trends that were discussed in the slides previously. If you think about what's going to happen in the next decade, you've got the number of U.S. citizens in over 65 years are expected to increase 50%. You've got annual health care expenditures that are increasing annually, projected to increase annually at 6%, and ultimately to account for almost 20% of GDP at the end of the 10-year period. You've got, as a result of the increased demand, as a result of the Affordable Care Act, you've got projections for employment in physician offices over the next 10 years. They're expected to increase 30.5%. You compare that to total employment, which is projected to increase 6.5%. You see the strong demand for new space. And then finally, I think you add in what we're seeing and starting to think through more globally as it relates to suburban office, but I think MOBs would be certainly impacted, as would retail. The move out of millennials, the largest demographic base, from the more urban core centers to more select suburban markets, particularly as they start to form families. And we think this creates a pretty compelling overall investment thesis for the long-term investor. And so I think the investors we speak with, their only change in view really from last year, again, those taking a long-term perspective, is a regret that they haven't acquired more to date. So it's a pretty bullish statement, I think, on the state of this sector.
That actually dives right into where I wanted to go next, which is to talk to some of the guys on the panel who are actually in the market buying properties, and talk a little bit about the strategies. Mark, let's start with you. So HTA's closed, I think, about $600 million of acquisitions this year. which is your highest volume, I think, since 2010. And what I want to see if you could expand on is kind of what's driving that view, what you're seeing in the market that's the kind of, leading you to make the decisions you guys are making in terms of buying properties.
Sure. Well, first of all, regret that Scott's not here, and I won't pretend to speak for Scott. That would be a mistake. But I will try and add to the content of the discussion with the hurricane and everything. He sends his regrets that he couldn't be here. I think Randy's comments are consistent with, I think, our view, and that is as a long-term investor, as a real estate investment trust that really seeks for the long-term growth and shareholder value, we need to be able to match our capital with the acquisition environment. The environment we're in is a product of a phenomenon that hasn't been seen before, at least I don't think so. Internationally, the search for yield, both directly coming to the States, wanting to invest in the dollar, invest in real estate, and secure the principal. They've done that through private equity, but they've also done it through institutional investment flowing into REIT. So I think there's been a tremendous opportunity, both internationally and nationally, to get invested into the medical office space, something that 8 or 10 years ago really wasn't available, at least certainly not with a menu like we have today, and we can talk about that a little bit more later. But that always needs to be tied to the acquisition environment. And we've been very fortunate that we have a very strong multiple, with the exception of when the Fed speaks. We've had a very strong multiple, and we've been able to raise that capital, whether it be debt or equity, at times when we needed to. We'll match our acquisitions with the capital, again, whether that's debt or equity. And there have been enough opportunities in the acquisition environment this year, even though the trend is a little bit lower than last year's. There have been a lot of transactions in the space, and being a 10-year-old firm investing since 2009 exclusively in medical office, it really allows us to focus our efforts. We're not looking at multiple product types or asset classes. We're not even looking in all the various markets. We're a much more focused investor, and I think that's allowed us to use our relationship investing style to find opportunities, and when we find those, be able to raise capital to match that and lock in those spreads. So that's largely the environment that we found ourselves in.
Can you talk a little bit about the pricing as it relates to some of the numbers we're seeing on these charts and the difference in cap rates between on and off, and also between the kind of the higher end stuff and the average?
Yeah, it's changing dramatically. It's interesting to see it in a chart because it becomes much more real. You hear the numbers, but you feel it. And when you're out there in the space, I've been doing this for 28 years, and off-campus was always the redheaded stepchild, as it were. It was out there, but it wasn't an institutional product. We've focused, HTA has focused primarily on campus in our early history. We're now probably 60-40, or 2/3, 1/3 on campus versus off. But you are seeing a lot more attractive off-campus opportunities. And I say attractive because they're relatively new developments, a lot of them. They're a lot more institutional quality in terms of the construction of the asset, and they're also institutional from the standpoint of the tenancy. So you're seeing a lot more physicians, practices who sell to the hospital. That credit becomes hospital credit, and then they take over that space and become sort of that flag or that marker in the submarket. The other, I guess, maybe more direct answer to your question is ever since 2008, we've seen cap rates on average gradually decline. I mean, we were buying in the mid-8s in the good old days in 2009 for very good quality assets, and that's just continued to match the interest rate environment that we've been in. So we've continued, every year you see it go down, and I can go back and look at all my transactions, and as long as we're locking in that spread, we're doing what we think we need to be doing because we're buying quality assets and we're matching the capital in the environment. But the more buyers, the private equity we talked about, we'll talk about that a little bit more, I'm sure. I like to think that the private equity buyers of today are the private equity sellers to REITs tomorrow. So hopefully there's an opportunity that will continue to recycle. But I think the more folks in the space has led to much lower cap rates. The international and national interest in a stable yield has led to more compressed cap rates. And I think the long-term value, if you will, based on what the Fed has said about the next 4 or 5 years, we're in an environment where just locking in to a 3.5% or 4% yield is very attractive, at least for some part of institutional or individual's portfolio. And I think that there's a lot more investors. That's led to more capital, and you're seeing capital chase cap rates down.
And obviously, as you mentioned, the capital raising side is a very important part of the equation. And so I'm going to definitely come back to you guys on this side of the stage to talk about that side. But first, I want to round out kind of the buying side of the equation, the actual acquisitions, before we get to the capital raising part. And Jeff, what I wanted to talk about with you is the Catholic Healthcare Initiatives deal and the large portfolio purchase that you made, and how you think that those types of deals might play in the overall acquisition spectrum, and whether or not there's other portfolio deals to come, what the hospital systems are looking to do in terms of that regard, and if you could add some color on that.
Yeah, absolutely. So the Catholic Health Initiatives acquisition deal, a $700 million deal, about 50 buildings across 9 regional systems. It's been a tremendous success for us. We actually met yesterday with the management team of CHI. They're based here in Denver. And that meeting was kind of an advertisement for why these systems should sell their medical office buildings. They're very happy with how it's gone. We closed the bulk of the transaction in the second quarter. And it's things from simple things like how fast we respond to service requests versus their existing real estate team. I mean, just because we're focused on it every day, we bring technology to bear that they didn't have currently in their real estate portfolio. And we also focus on improving the quality of that portfolio for that healthcare system. The transaction was largely stabilized when we bought it, but there was some vacancy, and we've made significant progress on leasing up some of that space to doctors that are synergistic to the existing healthcare system, that can add referrals, add revenue to the system, and increase profitability. And so if you think about a healthcare system, they just have limited resources, both time and money, that they're going to devote to their real estate. So to put it in the hands of somebody who's really focused on that, and that's what they do every day, I think they're getting a tremendous benefit from it. And so it would naturally lead me to think that over time it's just inevitable that these healthcare systems will continue to monetize this real estate, recognizing that people have been saying that for a long time, and it hasn't really happened as quickly as most people think. But when you look at the results and you look at how happy they are with that transaction, and the feedback that we've gotten from other healthcare systems with that transaction, it seems inevitable that that's going to happen over some period of time.
Does that lend itself to more and more large deals like this, and how does that play out?
Yeah, I mean, this deal was, I believe, the largest ever directly with a provider. So, I mean, that would be fantastic if we had more large deals like this. I think the reality is you'll probably see smaller deals as they become more accustomed to doing this type of transaction. But over time, I think just the total volume of those types of deals will continue to increase.
Okay, great. Chris, so Mark mentioned the private equity side, and we have this chart from earlier about the different buyer types. So I was curious if you could give some perspective maybe on the different investment strategy that a private equity buyer might have versus these two guys, and what you're seeing in the market, what you're looking to do, and how you're attacking it.
Sure. Happy to do it. I think first, when you've got to, define private equity. And what's happened is there's been a little bit of a shift and a change in exactly what private equity is, because a lot of times people assume private equity is closed-end investment funds that have some sort of term and will have to sell the assets at some point. That's really evolved. So what you're seeing in this box is really separate accounts, where you have foreign buyers coming in with a separate account manager that have a long-term hold strategy. You're seeing a lot of open-ended funds, which are long-dated funds that really have no exit strategy, that are buying these assets. So we as a firm have both closed-end fund and an open-ended fund. So what's increasing is, to the earlier point, there are more private equity buyers that are creating structures to hold these assets long-term as people look for yield. And really that's what we're seeing. And the challenge is, when you get to the pricing and start discussing about some of the pricing, you're seeing a lot of this private equity is really foreign buyers through separate accounts with U.S. asset managers that are paying big numbers for this as they look for yield. So I see that what we're finding is, as we look at our open-ended fund, a larger piece of it is becoming more healthcare focused. We're seeing more interest from our investors in increasing the healthcare component of our portfolio. So I certainly see this increasing. But the challenge really is when it gets down to, when you talk about some of the pricing, the bifurcation, the 4.5 cap rate deal, what happens if you do see a change in interest rate? What happens when the foreign buyers are unhappy with the returns that they're getting? What's going to happen to that private equity, for that private equity space? But in any event, I think it's going to continue to grow, and I think the capital, the takeaway really is the capital that the private equity is setting up is trying to match with the REITs in the sense of how do you go work with these health systems? We want to work with health systems, and I don't believe health systems want to have a guy who's coming in to hold for 2 or 3 years and sell. So we really want to try and set up long-dated capital so we can work and be flexible and creative with these health systems to think long-term about our investment strategies.
And how's the response from the systems that you're talking to?
It's been very interesting, and as a firm, we only focus on sort of non-traditional spaces. So in addition to healthcare, we're also very active in the student housing space, in the storage space. But what we're doing in the education space is very similar. We're working with these universities, and we're working and building them on-campus facilities. And so we can go in, and the groups that are only doing it today have been some of the REITs. So one of the things we're trying to do is there a way to work with the REITs? Is there a way that we can work directly with these universities because we have sort of long-term patient capital? And we want to be in it for the long haul. It's not a trade for us. A lot of private equity guys are coming in and out of the market because they see a trade. It's really, we've been doing this for 11 years and want to do it for another 30. So we're long-term in this sector. So I think when you go work with these hospital systems and you say, look, this is the business that we want to be in. This is really where our focus is. I think it's working well. I think it's working well, and I think the bottom line is you have to have patience because things do move slower. And I think the volume of activity is more as a result, I think, of the opportunities rather than people wanting to do them. I think it just takes time in this industry, as everyone here knows.
Great. So let's shift for a second to the capital raising side. And Peter, I'll start with you on the equity side, and these guys mentioned it. We've seen big equity deals from both of these guys, and also Medical Properties just did one for their hospital acquisition. How do we look at the capital raising versus the opportunities? Does the opportunities beget the capital? How are the issuers thinking about raising money? What's the market thinking about? From your side of things, what would you add into this discussion?
Yeah, I think I spent a lot of time talking to the various healthcare REITs and giving them updates on when the markets are. The healthcare REIT sector right now is in what I would call a virtuous cycle. If you have a strong cost of capital, both debt and equity, you trade at a premium to NAV, the market gives you a lot of opportunities to go and raise capital to do acquisitions. And I think you're seeing that right now, specifically for the MOB REITs as well. I looked at a chart last week that showed forward AFFO multiples were close to 20 times. In fact, I think HTAs may be above 20 times. And when you think about the inverse of that, your cost of equity is sub 5%. When you think about where you can raise debt capital today, it's sub 4%. It's actually close to 3%. We did a bond deal for Ventas that was 3.25%. I think HTA did a bond deal at 3.5%. If you think about a 50-50 debt equity mix for acquisitions, you're looking at pretty cheap capital out there. And it's this phenomenon of investors chasing yield right now. That's equity investors, that's private equity. And so I think right now you're in this virtuous cycle. I don't see it changing dramatically over the next couple of years. Mark did mention the Fed. Everyone is very focused on the next raise in rates. And I think REITs will be volatile over certain periods of time depending upon what economic indicators there are. We have the employment report on Friday. But my personal view is that rates are going to remain low for a long time. So I think this cycle is here for a while. But you can also look at the skilled nursing space, which is actually in the opposite cycle. They're not in the virtuous cycle. They're in what I sort of refer to as the vicious cycle, where they don't trade at, a good cost of capital right now, so it's hard for them to go out and acquire assets accretively, and they're doing the opposite. And you see companies like HCP spinning off their skilled nursing portfolio. I know Welltower's out there trying to sell some of their skilled nursing assets right now. I actually think if you're have a very long-term view and you're a yield buyer, that skilled nursing is a good asset class to look at right now because it's at its low point.
10% cap rates instead of 4.5%.
10% cap rates instead of 4.5% cap rates, but you have to take a contrarian view on those types of things. So, I think the capital markets are wide open for REITs in that virtuous cycle. We did a deal for Medical Properties Trust last week. We launched a 33 million share offering, and within 2 hours we had over 90 million shares in the book. We were able to price the deal that night. The use of proceeds was to buy Steward, the hospitals out of the Steward health system, which is owned by Cerberus. I was a little surprised at how much the book was oversubscribed as quickly as it was, but it goes to show you that I think if you can put smart deals together and go out and try and raise equity capital around those transactions, that the market is there for you right now. Doc's done it a bunch of times. They did over a $400 million deal for the CHI transaction. HTA has done smaller deals, but the market is wide open for them. And also there's another phenomenon for REITs is REITs can actually issue equity capital through their ATM programs, which don't show up every day. But when you look quarter to quarter at how much equity capital is getting issued under those programs, it's pretty substantial. And that's been a nice tool for REITs to be able to fund these one-off acquisitions.
I want to come back to the equity side with you guys and kind of discuss the differences between the public sources of equity versus the private sources of equity and what the liquidity looks like. But first, I wanted to kind of touch on the debt side with Jim. So Capital One acquired GE Healthcare. What's changed in terms of kind of the appetite to put capital out? What are you guys looking at? What are lenders thinking about? How does the debt side of the business look like? We haven't really talked about that yet.
The biggest thing that's changed is I've heard what's in your wallet about 300,000 times. But really nothing has changed. I mean, Capital One acquired the whole business, so they acquired all the people, the pipeline, the book, and we merged what was GE Capital's healthcare finance business with Capital One. So really our risk appetite is identical to what it was before. I think the biggest thing that's changed is at GE Capital, we were somewhat limited with the non-bank cost of funds, and we really could only play in a higher leverage product. And now that we are a full-fledged bank, we can offer a much broader range of kind of risk-based pricing. We can do lower leverage deals at lower pricing, which really wasn't available to us before. So if anything, we have a much broader product suite for our customers today. We can offer them a variety of leverage alternatives. And then of course, we have a host of bank products that come with being a bank, which we didn't have before as well. So, and then lastly, I would say, from a people standpoint, we combined two pretty successful businesses. So, virtually everyone has stayed, and I think from a talent standpoint, we're better than ever.
And what's the market look like today in terms of appetite for putting capital to work, and how is the business going? Where's the pricing, the demand?
Business is great. I mean, this chart is good for us, right? I mean, obviously the higher percentage of private equity buyers are our primary customers. So the higher percentage of the market that's being acquired by private capital, the greater opportunity for us, and our business is tracking along with that. I mean, this will be a record or near record year in terms of financing volume for us. Certainly in the MOB space, maybe to a lesser extent on the senior housing side. From a term standpoint, I mean, if you look at the historical spectrum of what lending terms are available, then they're very attractive right now. I think, so there's plenty of debt capital available, certainly on stabilized assets. I think where you see lenders react with a little more caution is our transactions with a significant amount of execution risk. I think terms get a little less aggressive in that case, but very much still a very strong market on the debt side. And we look at all the things these guys have just talked about, right? I mean, we're very bullish on the longer term demographics. We do business really only with established track record buyers who we trust, even though prices get a little more aggressive. We understand their investment thesis. We largely are longer term, hold positions, and we can typically match an attractive debt product to that business plan. So the business is great.
One thing that I hear a lot about that I'm curious on your take is you hear a lot of noise about kind of the government's or the regulators focused on the concern over CRE volumes and CRE exposure. Have you seen any impact of that? And is that a concern in terms of either the book, the size of deals, the amount you can do, or your underwriting?
It's a good question, and obviously I have an interesting perspective on that because we went from being completely unregulated GE Capital to trying to be regulated GE Capital to being fully regulated now. So we've kind of gone through the whole spectrum. I mean, the truth is, as a regulated institution, you have more constituencies, right? You always had the customer, you always had your share owners and an adequate return on your capital, but now you have depositors and you have regulators as well. And I think the regulators have certain things which they're going to look at from time to time. And to your point, real estate valuations are one that they're looking at. But as far as us in how we are in the market today, if you have established processes, if you have people who've been through it, been through cycles, been through it before, there's plenty of overlap in that Venn diagram between what buyers want to buy and what lenders can lend on and still build a safe, attractive portfolio. So it really hasn't affected us much at all, really. If anything, our average loan to value now is we were acquired December 1st, so I guess we're coming up on a year now. If anything, our average loan to value is lower, despite the more aggressive market today, than it has been in the past. So while it's a new constituent and it has to be actively managed, it really hasn't affected our ability to satisfy the needs of most of our customers.
I'd just add, like the physicians' employment in the offices, the compliance departments and regulated banks are exploding at the same rate.
Yeah.
So it makes it more challenging, but all the banks have, particularly larger banks, have added the firepower to get through the regulatory environment. It's additional cost. It's got to be borne by the consumer eventually. But the controls are in place to make sure that happens.
I hear the word regulator and I shiver a little bit working at a bank. I would just say we do a lot more work when we originate loans than we did before. There's a lot more paper that gets put together and gets filed away. I don't think it's gotten to the point in real estate where it's impacted our ability to put capital out. Certainly in other sectors it has had a little bit of an impact, especially on our leverage finance business, where there are limits to the amount of leverage we can put on businesses. So if Apollo wants to go out and buy a public company, they bought Diamond Resorts, there's a limit to how much debt they can actually put on that transaction. Commercial real estate falls in a little bit of a different bucket, so there's a lot of paperwork that gets done, but we're not seeing our inability to put capital out at this point in time. We're still able to do it.
What are you guys seeing in terms of from the borrower's side, to the extent that you need to access debt in one form or another from these guys? Any impact on your ability to access capital? Any changes in your either the liquidity or the cost of that?
Yeah, I'll jump in. So, we're largely an unsecured borrower. So, the banks have been extraordinarily aggressive in their lending terms with us. And I think it all kind of revolves in one big cycle. Pete talked about the virtuous cycle. I mean, we're issuing a lot of equity. we're generating a lot of fees, and I think banks are very aggressively trying to build their relationships with us on the debt side as well. So we recently redid our line of credit, got great terms that, a couple of years ago probably would have been unfathomable. But, the lending there for us, at least on the unsecured side, is infinite really at this point.
I would agree. As an unsecured borrower, we've had plenty of demand when we've gone to raise. I think a lot of it has to do with the sector. I mean, you're in a conservative industry and in a conservative asset class. You have a conservative balance sheet. We're between 26 and 30% levered. A lot of lenders like that. They like the ability to put money to work in a safe, conservative environment. And the reason we're low levered is we know not everything lasts forever. So there'll be a time when that will pay off. But I tend to agree with the comments here that it's going to be a long time. I think interest rates are going to stay low, which means cap rates are going to continue to stay low, compress potentially even further. I would say that they've probably stabilized to a certain extent if you take out the outliers on the high and the low. But they have room to go if you look at multifamily and self-storage. But the lending environment hasn't been an issue at all. It's been oversubscribed, much like the equity.
What about for the private equity side?
Well, the borrowing is there for these sectors, certainly. I think, what we've been doing is really trying to focus more on relationships. Because, we've been through a downturn, we've seen a cycle, we've seen what happened. We really want to partner and look at the lenders that we work with as partners in the business. And so for us, it's really about not trying to eke out the best terms. It's really who do we want to be in partnership with long term? Because we have different programs. We've got, in some of our funds, we'll have 60 to 70% LTV borrowing. In our other fund will be 25 to 28%, where it's longer term. So for us, there's capital out there. I think the lenders are looking for folks that do have track records. And there is an abundance of it right now, but for our firm, we're trying to do more with less. Because again, a little bit contrarian, I think where we are in the cycle is getting to the end. I think we've had a 9-year bull market. I can't imagine when I look at 10-year underwritings that we're going to have another 10 years of up and up and up. To have a 19-year run of everything going up, I think is challenging. And I look at how people are underwriting deals. I look at how people are assuming rent's going to keep growing for 10 years. People think exit cap rates are going to hold. You take a 4.5 cap rate deal and you put a 5.5 exit cap rate on in 10 years, and it's not the best return. So I do think, in this sector, if you pick the right assets with the right health systems and you underwrite it and manage investor expectations. And that's my concern in the private equity side, is that a lot of people are underwriting to perfection and they're going to mismanage the expectation of their investors. And I see that more in the private equity world, where, again, great solid investment, you can, if you underwrite it, in the right way. But my concern about what some of the returns people think they're going to achieve, and again, I think there's going to be some bumps in the road, so you really got to be with folks that know what they're doing, with the operator side, with the right hospital systems, and you got to have lenders that really understand this business and view it more as a partnership.
So I noticed you shaking your head when Mark mentioned still room to go, cap rates lower compared to storage or compared to apartments, and I forget what else you said.
We're not supposed to have those two cameras.
And you you invest across these different spectrums.
Yeah.
And so actually that you raise an interesting point. And so how do you, at your firm where you're not dedicated to one space,
Yeah.
how do you think about asset allocation, and does it come, is it based on that underwriting? Is it based on what investors want? How do you at your firm make those decisions?
It's interesting. I think in the asset classes, whether it's storage, student housing, medical office, these are very fragmented asset classes. So there is a premium for portfolios, no doubt about it. And I think one of the ways to sift through this kind of environment is a lot of onesie-twosies. When you start thinking about on the private equity side, 60% of the money has been raised by 10 firms. And these firms are very large private equity players. They're not going to go do a $5, $10, $15 million deal. So I do think there is, when you start looking at cap rates, there is differences between one-off opportunities and what there are in portfolio premiums. But it is a challenge. There are deals out there that we really like, and we look at some of those cap rates, and it's hard to underwrite And frankly, we're not as a firm going to do it. We're not going to underwrite cap rates holding or compressing. We're just not going to do it. We're not going to assume interest rates are going to stay low forever. It might happen, and we might be absolutely wrong. And I can tell you, we've been doing a lot with borrowing over the past few years, where I keep saying fix our debt, and it keeps being wrong. But so I think they're big markets. I think the medical office market's $300-400 billion. They're big markets, so there's a lot of opportunities. So I think the way that we're going to try and play it is really pick those good, solid investments. We're not going to bid things up where I think some of the competitors are doing it because you've got to just hit everything perfectly right. I think that's a challenge. But so I get the big picture is for us, it's going to be a lot of one-offs, create portfolios, and then we think there's value to that.
So does anybody else want to jump on the little bit more bearish view that we've got from over here, or as we look forward and think about where we are in the cycle and where we're going, whether it's for the next 12 months, or for over a longer period of time?
I get back to the fundamentals, and I think from a capital perspective, if you look back, well, I would absolutely agree that you're pricing a little bit more risk into the underwriting today. It's not anywhere near where we were in 2006, 2007. If we went back and looked at sort of traditional office deals in our system and then compared that deals to the deals we saw in 2015. In 2006, you were using very aggressive lending, much higher debt costs, and you're putting on 80% leverage by and large. Your cash-on-cash returns were 1%, and to hit those returns, you had to have dramatic increases in rent. Today, the average office building, and I think it bears fruit in this space as well, is about 50% LTV. You've got cash-on-cash returns of 5.25% still. You've got debt service coverages that are pretty healthy. And they have contracted. There's no question they've contracted in the last several years, but still room to run to some degree. And we've been trying to project when the next rate increase will come and when the long bond will actually move. It's a global environment today, and when you look at the German bond at 10 basis points, there is a ceiling on, from a global perspective, on where the 10-year can go. Our view is that when the Fed does move, that the yield curve will flatten. And as a result, we do see lower for longer. I mean, I do get a little nervous, and that is becoming a universal view. And when that does become a universal view, there seems to be a black swan event right behind it. But at least for now, I think our best bet is that it will be lower for longer. And as long as you're match funding your capital stack, you will still be able to generate pretty attractive returns in a sector like this. And so I think you are seeing migration out of many of the core urban markets, office markets. A lot of forward capital saying, look, I'm not sure about the run rate in downtown New York office. And it gets run its course. Are there other pockets of capital? And many of those private equity sources are looking to folks like Harrison Street that have an acumen in this space. Finding that operating partner is very difficult for them. And I think you'll see this private equity portion of the pie continue to grow, but it's going to take a while, as Chris mentioned, because you do have to find the right operating partner, and many of those folks can't do it on their own.
Anybody else want to give their view of the future, either bullish or bearish?
Well, I think there certainly could be bumps in the road over the next 5, 10, 15 years, whatever it is. We see it from time to time as you sort of see, well, the Fed's going to meet, are they going to raise rates? And you see it on a very short-term basis right now. But when I looked at one of the charts that came up at the beginning of the presentation, it talked about the amount of real estate that was out there in MOBs and in the hospital sector. I think it was around $1 trillion. That doesn't include senior housing assets, which I think is probably an equivalent amount of real estate as well. And when I think about the current equity market capitalization of all of the public healthcare REITs, it's just over $100 billion. I think it's around $120 billion. And you look at the amount of real estate that's out there in the healthcare space, it's in the trillions. So when I look forward, whether rates go up 50 basis points from where they are today or stay flat, I still think over the next 10, 20, 30 years that there's a lot of product that will migrate its way into the hands of the REITs as well as the private equity guys out there. And then ultimately, I think when the private equity guys look to sell, the REITs are the best buyers of that product. So, if I have a crystal ball and I look out, I can't predict necessarily where rates are going to go. Whenever Wall Street tries to predict where rates are going to go, we're usually wrong, and then we change our opinions, and then we're wrong again, and then we continue to change. But I just see a lot of solid transaction volume over the next couple of decades.
Randy, one of the big buyers in this space, and frankly in a number of other REIT sectors over the past couple of years, has been the non-traded REITs. Mm-hmm. And it seems as though that buyer universe is changing, for lack of a better word. Where do you see that? Does that business come back? Does it evolve? Does that change the overall buyer landscape, the overall liquidity landscape for this space?
I think it will, and it's certainly already impacted. And a lot of the REIT data, you see the decrease. A lot of that's probably due to the non-traded REITs and the listed public companies, given their pretty attractive cost of capital, particularly in the second half of 2016, are making up for a lot of that downfall. But the non-traded REIT capital raising space was down 55% between 14 and 15, and 2016 will be down even further. And you're seeing regulatory changes, how they have to disclose their investments to the public. You have a few systems that are dealing with the aspect of bankruptcies and fraudulent events, and so that's certainly impacted the brands in the space. But what you are seeing is a backfill now, where you see Blackstone's BREIT. You're seeing Cantor, who acquired 29 of the 30 top wholesalers from the ARC platform, and are putting together a product, and one of their 4 avenues will likely be healthcare. You're seeing Apollo, and you're seeing a number of other institutional investors who are looking to come into the space, use their brand, change the dynamic of how that capital is being raised a little bit more advantageous to the investor and a little bit less in upfront fees. And I think that will change the nature of the space. It's going to take some time for all these new players to come into the marketplace. But by and large, the MOB profile fits very well for that product. And so it's on the downturn. I think it will come up as new entrants come in the space. Many of those same investors have largely not done healthcare previously, and will probably look to build a healthcare team in order to take advantage of the pretty steady cash flows that come off of the sector.
Yeah. I think it's higher quality sponsors coming into the space, which is a good thing overall. And the sponsors that were in the space up and until now, not all, but many of them were just focused on the fees they were able to generate and less on the quality of real estate they were buying. I think if you look at someone like Blackstone entering the space, they are very focused on their brand and on the quality of real estate they buy. So I think long term it's a good thing. And I also think it's a good thing that you're sort of weeding out the lower quality sponsors that enter the space.
I would just add,
you guys came out of that world.
We came from that space, so I know exactly what you're saying. And I think the days of just aggregating a bunch of assets that don't have any relationship other than that they're in healthcare is going to be a challenge. And I think the thing that wasn't brought up is the exit strategy. The exit strategy for HTA was defined early on. We were defined to be and mission built to be a public company. The other majority of the other, at least in the healthcare space, of non-traded REITs basically have sold to either private entities or combination public-private like Northstar or Ventas acquired in our portfolio. Those exit strategies, I'm not sure that they've worked that well. Northstar is looking to sell off 45 of their assets that they acquired from Griffin, and I just think that's less clear. So without an exit strategy, I think it becomes more difficult to see those being successful over the longer term.
Do you view them though as, to the extent that it does come back, and you've got names like Blackstone in the space, are they viable competition for assets in the short term?
They are to the extent that they have relationships in the space. I think this is it's a fragmented business, but it's a very small world. I mean, these are the people who are involved in healthcare real estate. I mean, it's not in a big convention center. It's a very small world. I think the relationships become really important both in finding the assets, being able to attract those sellers to you as opposed to somebody else, rather than just continuing having to bid up the price. They have to have competitive capital, and I think from HTA's perspective, so we're biased, having an operating platform where we can be directly involved in the leasing, the management, and the maintenance of the buildings gives us an additional advantage in working with the tenants, the submarket, the hospitals, and the health systems. I mean, relationships are what it's about. To the extent that the new sponsors can either buy a platform or create those relationships along with buying assets in a cost of capital, that's competitive. I think they can be. I would say the non-traded REITs today have not been, at least to my knowledge, haven't been in the same space we've been in. So we haven't been competing with them. They're typically sopping up, one-off assets that are more eclectic. Like I said, just smaller assets or smaller portfolios that are not of institutional quality, or at least the institutional REITs weren't attracted to.
And their cost of capital is higher, too. I mean, they have dividend
Significantly.
yields that,
Right.
are 6.5% to 7%. So that's sort of their bogey when they think about the cap rates they're looking to buy assets at, which is not the same quality of assets that
Right. On the
guys
medical
over
office
here
side,
buy.
they're having to buy, either a more rural or tertiary market, but they're also having to buy hospitals or assisted living or other things that have a higher yield to balance it out. That's
And
right.
that's not to mention the fees that they're tacking on, in addition to the dividend that they're paying out.
Right.
A lot of this keeps coming back to cost of capital, and so what I wanted to ask you guys, the REITs on the stage, and also Peter, you as you talk to equity investors when you're selling these deals, what are the guys on that side of the table, the people who are handing you the money? What are they thinking about? How do they look at the market? It seems like it can be a fickle bunch, right? If you looked at the multiples of healthcare REITs a year ago, or maybe not a year, but 12 to 18 months ago, medical office wasn't trading where it is now, right? You weren't at the highest multiples in the group, and it's switched. And so, 12 to 18 months down the road from now, things could switch again. So when you talk to those guys, the institutional equity investors, what are they thinking? What are they telling you?
Yeah, I think we've talked about sort of where that money is coming from. So the search for yield is creating this opportunity for them to get invested. And I think they're looking for a defined strategy. And I think, not speaking for the other folks, but I think each of the public MOB REITs have a different strategy. They've defined, or we've defined our own way to play in the space. I think it's complementary. I think it's good for all of us to have that investor be able to make a choice. Do I want to be in Physician Realty Trust? Do I want to be in HRT? Some want to be in a diversified investment, or in the case of HTA, medical office, without a development component, just the acquisition, a very simple model. And so I think they're looking for a defined strategy. I think they're also looking for discipline on execution, and that not only relates to acquisition and raising capital, but also being able to generate consistent performance. For us, that's 3% same-store growth quarter to quarter. For other folks, it may be a little bit different, but I mean, there needs to be some evidence that investor has not only made a good investment, but has made an investment that continues to perform to some expectation over time. And I think they're looking for consistency in that message. I don't think the strategy can change every other year. I think you have a strategy, you stick with the strategy, you execute, you hit the metrics you've set out, and I think those, whether they're equity or bond investors, will continue to want to stay invested. They're not going to put all their money in one platform, and they're not going to put it all in one sector. But I think they'll continue to invest.
Yeah, and just to add on that, I agree with all that. But additionally, we benefit from being in a sector within healthcare that is very stable. So you think about 5 years ago, you had senior housing NOI growth of 6, 7, 8% year over year. You had a lot of investors chasing that kind of NOI growth. You also had a lot of developers chasing that kind of NOI growth. So now that paradigm switched in that investors are starting to be more concerned about oversupply in the senior housing sector. Medical office buildings don't show that same sort of supply issue. On the other kind of pillar of healthcare real estate would probably be skilled nursing. There's a lot of government, there's always the government concerns of skilled nursing, but you've also seen this big privatization, this Medicare Advantage plan that's really wiping out those margins, and nobody really knows where that's going to stop. So I think as you look at a dedicated REIT investor who's kind of trying to allocate within his healthcare REIT portfolio, he's saying, you know what, right now medical office buildings offer really the best risk-adjusted return that we can find within healthcare real estate. And I think we've both been benefiting from that and getting outsized allocations because of the property type that we're in, as well as the strategies and relationships that we have within that sector and the performance that we show, the consistent performance that we show.
You know, if I could add one thing real quickly. The one investor type that we haven't touched on or haven't talked about are those sellers that are looking for a tax-advantaged exit. We have, as cap rates compress, there's just that much more gain that somebody's looking to take advantage of and not pay the tax man. So I think both for Physician Realty Trust and HTA, we've seen a significant amount of interest in the UPREIT structure, and those folks are looking to diversify, not out of medical office, but from their own medical office property or properties into a larger portfolio, something that has liquidity to it. It's not a 1031 trade where either I need to continue to do the 1031 or my heirs need to find a way to continue to do that. So they're looking for a way that they can get liquidity through a public vehicle. And that's been much more attractive, again, partly driven by cap rates compressing, so there's that much more gain to be concerned about, and partly because now they have investment vehicles that are, you know, billions of dollars in size and enterprise value that become liquid exits for them, and they can manage that tax burden.
Are you suggesting that people would not pay taxes? I thought we learned last week that that's not a acceptable strategy.
As long as you don't break the law. You know, it's like the law
Tax
says you can.
deference.
Peter, from your perspective, as you talk to the equity investors, as when these guys are out in the market and you're kind of gauging interest, are you hearing anything different or anything that you'd like to add?
Well, I think equity investors understand the MOB space better now than they did before. There are 3 pure play MOB REITs that are in the public healthcare space now. Before it was really just HR. And you've got DOC and you've got HTA who've been public for a couple of years now. So I think investors understand the space better. Investors are obviously looking for solid, NOI growth, which they understand within the space, and that's consistent amongst all 3 of those REITs. They're also looking for, the right management team to support, because it's not just the real estate, but they want to support the management team as well. So when companies go out and do equity offerings, we see consistently the same investor base supporting the company. And Jeff and I have talked about it before, and he has said oftentimes that they have a great shareholder base that will support them as they do acquisitions and as they do offerings. And I'm sure it's the same thing at HTA. I know it is at HR as well. So I think the other thing I would just add, though, is if you look at equity raises that have happened over the last year, if you have a specified acquisition that you can go out and market to investors, the discount at which those deals are able to get done is around 2.5% to 3%. And if you look at other REITs that are raising capital just to pay down debt or for general corporate purposes, the average discount is around 4 to 4.5%. And so what does that tell you? That tells you that investors are looking for smart acquisitions and growth. So they're looking for all the core tenants that we talked about, that Jeff and Mark talked about as well, but they're also looking for growth. And I think that's a very important piece, and they're looking for smart acquisitions, and they're willing to support those acquisitions as well. And we saw that with Medical Properties Trust, which is a different asset class with hospitals, but really it was existing investors and new investors, and that priced at around a 3% discount, which is actually pretty phenomenal for the size of the equity offering that they got done.
Yeah, when we were on the road with HCA for the recent common deal, I think what we heard by and large from investors is, sub 5% trading cap rate. We're not thrilled about that, but alternatively, where else are we going to put our money? And 2, we're investing in a management team that we trust, and because of their capital position, their trading ability to take this advantage cost of capital and grow, I think that's an important part that Peter mentioned. We are not looking at the current yield today. What we're hoping is that in 2 to 3 years, that yield's going to be a little bit more in the ballpark that we're comfortable with. And we're going to trust in that management team to deliver and just take advantage of their cost of capital to grow NOI and FFO growth, the bottom line, to get to more normalized levels. But in the interim, there's not really a compelling alternative.
I would, on the private, fundraise, the focus really has been, if you look at the pension funds and a lot of the capital out there is really looking for more defense defensive investment asset classes. And so I think people are, when they look at the traditional, people are getting concerned on the private side of where things are trading and the pricing of traditional real estate. So a lot of what we're hearing from the investors that we're talking about is looking for defensive strategies, one that have less volatility, more capital preservation, and this asset class plays perfect into that strategy.
Before we open it up to audience questions, if there are any, I wanted to kind of touch on something a little bit broader and open it up to everybody. Basically, what I wanted to try and talk about is kind of the overall state of kind of the healthcare spectrum. Everything that's going on, and it was touched on in the presentation earlier about the Affordable Care Act and more insured, and movement to outpatient. Where are we in that? How is it evolving? But then also, what can happen in Washington that could change for the better or worse, what's going on with healthcare and how could it impact the MOB space? Jim, do you have a view on any of that?
I mean, there's a lot going on. Obviously, up the road, there's always a lot going on.
Yeah.
At the MOB space specifically, most of what has happened over the last few years with Affordable Care, like the Affordable Care Act is not about cost, it's about access, right? So from an access perspective, that's generally a good thing for most healthcare real estate, particularly the medical office building. Where there's a lot of activity that probably has a more immediate impact on the real estate and the real estate values, and Peter talked about it earlier, is in the post-acute space, right? Where you have 15,000 nursing homes and a payment model that's changing to the point where, where does that cash flow, right, level off, and what does it mean for how many nursing homes you can have? I don't see anything like that in the near term, in the medical office world. Sure, if who the hell knows what's going to happen in November? I defy anyone here to predict what's going to happen in November. But if the Affordable Care Act were to be repealed, then then you'd have a different conversation there. But at least the way we're looking at it, I don't see that in the realm of the likely.
Anybody else want to?
I can tell you, whatever happens in November is not going to be good. So,
Well, I don't think whatever happens in November is going to have any near-term impact on the real estate sector. I think the Affordable Care Act is broken from a cost model. I mean, it's got to be redone, thrown away, whatever it is, and it's just going to take time. I mean, our government doesn't do anything quickly. Probably the biggest threat is a single-payer model. I mean, to the extent that is something that moves forward, that has sort of more implications for our hospital partners and our hospital relationships, but you're still going to have people needing to go to a doctor to get treated, and I don't see that as an immediate short-term impact.
Well, you bring that up. So how are your hospital and your partners, the hospitals, the systems, how are they looking at the potential changes, the ongoing changes in the healthcare industry, and what does that mean for their expectations?
From a capitalization side, I mean, the Stewart transaction, we monetized the medical office buildings in 2012. MPT monetized the hospitals now. That's an investor-owned model, and they're looking to operate that health system, obviously for investor returns, but I think they're operating it more like Starwood did the hospitality model. I mean, the real estate returns are 8 to 12%. The hospitality or the hospital returns are something different, and you divorce those investors. So that's whether that plays out in a broader sense, I don't know. But there's certainly been some evidence that there's a capital that's attracted to owning the real estate hospital acute care assets. Ventas is in a RIDEA, if you will, with Ardent in that same sense. So that's got room to run. So we'll see if that recapitalization of the balance sheet for hospitals is real. Most CFOs and CEOs have no concept of what that is or why they would ever go that direction. They still think they have very cheap, and they do, inexpensive tax-exempt debt. But I think they continue, especially the nonprofits, continue to look at that as their cost of capital, and it's not. They have a very limited amount of capital that they can increase on their balance sheet, and I think they'll continue to monetize, as we've seen in the numbers, they'll continue to monetize their real estate. And there have been other transactions. I mean, CHI is certainly the most visible, and I think that will propel things forward maybe a little bit more clearly. But every year there's been 2, 3, or 4 hospital monetizations in the space. They just haven't been as large. as that. So I think it will continue, and it'll probably accelerate.
I mean, you could see, that when you talk about, compliance, regulatory costs, when we think about the buildings that we own, we're always looking at the underlying tenants and the profitability of their businesses. And, is there going to be effect on rental rates in the future if the costs within these physicians groups become much more expensive? And what does that mean 5-6 years out when you're trying to project rental rates for your properties? Certainly from the capital raising side for all of us, there's a lot of cost and regulatory and compliance, and that's making it very difficult for firms to raise capital. So you could see a situation where it's harder to get capital to the space. You could also see a situation where your underlying tenants have more pressure, and that could affect future rental rates. And so that's something that I think it needs to be looked at or underwritten or thought about as you think about the space.
Clearly.
So let's throw it open. If anybody in the audience has any questions for any of these guys, we're happy to take those. Don't be shy. And if not, then I will continue.
Mark
But-
Burkupper has a question. I know Mark's been dying to ask a question in this panel. Come on, Mark.
What do you got, Mark?
Sounds like everybody needs to drink some more coffee. Okay, Mike, what do you got?
Jim, so with the sort of increase in private equity activity that Hilda was talking about here, can you sort of unpack that kind of trend and sort of what are the types of deals that you're seeing in terms of private equity sponsors, and what types of opportunities they're chasing now, and how's that changed from a few years ago?
Well, the types of opportunities they're chasing, I don't know has changed all that much. I think, as we talked about earlier, the competition for those assets has changed a little bit. And I think, the public REITs are there. They've been there other than the period early this year where we had the stock market issues and they kind of backed away for a little bit. You're definitely seeing, the non-tradeds, back away, which were a big factor in, 13 and 14. Our approach is very similar to what Chris talked about earlier. We are very much a long-term relationship focused lender, and we like to get in with a management team, understand what their investment thesis is, and then tailor our debt to that thesis. So I don't think they're changing different opportunities. I think their win percentage is probably a little higher given some of the things that are going on in the market. Now, we've heard about international investing for several years. We're finally seeing it this year, where we've got across asset classes, whether you're talking about post-acute, you're talking about seniors housing, and even the medical office, where we're dealing with, U.S. companies that are backed by money from China and from other places in Asia. But that's still, we have had very few, at least of the investors that we've been financing, that have actually come through and won those deals, but you're starting to see it more regularly.
To the Chinese point, it's interesting. A lot of these Chinese groups that are coming in are doing it not only as an investment, but also as an education. And a number of these Chinese groups that I've talked to are doing it. They're saying, listen, we're going to have this issue, and we've got this problem back in China, so we need to get in and really understand it and learn about it. But it's amazing the amount of calls I've gotten from Chinese groups looking to enter the space.
One of the bigger foreign sources of capital coming into other sectors within real estate is from Canada, and obviously there's been some currency fluctuations that have kind of pulled that back. Are you seeing anything from the Canadian pension funds and any of that money that's looking to come here?
They're very focused on other asset classes. I mean, they're traditionally retail, multifamily, some office, industrial. They have significant overweight positions for healthcare as an asset class that, by and large, the larger players have not spent a lot of time in. But I would expect
They've started to come into senior housing.
I suspect that will start to change. You saw some of the JVs, and then they'll probably do that in a joint venture route. I think they'd love to partner with some of the REIT operators or be separate account investors with Harrison Street and some of the other folks in the private space that have the acumen. The REITs don't need the capital right now, right? So that limits the universe. And it is difficult to find those operating partners that are, quite frankly, flush with capital to take advantage of the space already.
I think you've seen a little bit. PSP and CPP have been looking at the space. think PSP has a big joint venture with Welltower as well on the senior housing side.
Yep.
And CPP has been looking at transactions. But they need to be in joint ventures. They need to be structured the right way. And that's all about just building a relationship. And I think that takes quite amount of time, just like it takes the same amount of time to build relationships with health systems. I think with some of those pension funds, it takes the same amount of time to build those.
Any other questions? No? Okay, so what I wanted to try and do, Chris was the only one who has put any negative perspective out there.
It wasn't negative.
Any slightly conservative, bearish,
Conservative.
whatever. So what I'm going to try and get the rest of you to do by asking the question a little bit different way, what do you worry about that could change things, be it November, be it the Fed, whatever else it is, what could kind of put a damper on the very bullish outlook that I think I've heard from pretty much all of you going forward? Anybody want to jump in on that?
Well, I mean, as a lender, we worry about a lot, right? I mean, we worry about almost everything. But I think, there's a lot of truth. The data says we are at historical levels when it comes to valuation, it comes to fundamentals, right? No one on here, I think, is debating that. Debate really was more around how long does it last. And, it's hard to imagine we're not closer to the top than to another 10 years of what we had the last 10 years. And so what we worry about is not really, especially in medical office, we're not really worried about the immediate term. It's more the stuff Chris talked about on the follow-up question, which is 5-10 years out, and what could be doing. The other thing we didn't see is when we looked at cap rates is we didn't compare it to other sectors, right? I mean, there has been a tremendous increased understanding of the space from a variety of different investor groups, which has kind of narrowed that cap rate gap to other more traditional real estate classes. And has that played out at this point? I don't know. I mean, there should, you would think, given everything we've talked about some of the regulatory and other things, there's a friction in healthcare or a stroke of the pen risk in parts of healthcare which don't exist in some other real estate asset classes. So we worry about fundamental changes in payment models. We talked about single payer and what could that mean. I don't think that's 1, 2, 3 years out. That's more 5 to 10 years out.
Yeah, I think what I would say we probably worry about more is not so much the catalyst. Something's going to cause the trend to reverse, whatever that is and whenever it is. I think it's the transition that I worry about. It's how it goes from being, 4.5 to 5.5 cap rates and interest rates, the 10-year going to 4 or 5. I mean, that has impact for households and companies and this nation's debt, all of that. So to me, it's a very, very macro issue that is the transition, whatever the catalyst, the transition from what we've been in to whatever that next thing is.
Yep. I mean, I agree. I worry about the macro, but really the bookend scenarios, right? The one scenario where all of a sudden we have a raging hot economy, which is just really hard to figure out how that can happen unless you get some kind of coordinated fiscal response or fiscal policy from world governments, which just doesn't seem in the realm of possibility to me. The other thing I'd worry about is a big recession where central banks are not stepping in anymore to try to cushion that blow. I mean, they've shown that they're very willing to step in with negative interest rates, et cetera, to kind of prevent that from happening. So, those are the two shocks that I worry about in terms of asset valuation. I think a much more likely scenario is that over some period of time, which may be a couple years out at least, we get some moderate economic growth, and then you can have some slight increase in rates and you don't get a yield curve flattening, which I think would happen if we tried to increase rates right now. I'm very rarely accused of being an optimist, but I'm more optimistic than my friend here.
Yeah. I worry about geopolitical risks as well. I mean, I work at a British bank, and when Brexit happened in June, it was pretty scary. And I've seen where the British pound has gone. I've seen where our stock has gone. No one from Deutsche Bank's on the panel, so I can give Deutsche Bank a hard time right now. But I saw some article that said, "Is Deutsche Bank the next Lehman?" I mean, I do worry about those events, and I don't think that you have a worldwide, unified monetary policy. And I think we're all beholden to what the Fed does, and what does the ECB do? What does Japan do? And I think there are some real geopolitical risks that we'll have to navigate through.
Again, I want to make sure I'm not, what I'm trying to paint is, or my concern is that I think there are people that have been in the space for a while and understand it, have seen it, have done it. I think there is a lot of headline excitement about healthcare real estate, about education real estate, and you're seeing a lot of people chasing yield or doing things that things have to work out perfectly for them to execute. My concern is this asset class will do very well long-term because, as we saw in the last downturn, we held occupancy, we outperformed, we preserved capital versus traditional office. So you're going to see, these are asset classes when you think of senior and medical that do better in a down market, and capital is now recognizing that. What the concern I have is some of the transactions that people are doing, I think may paint a negative light on the industry or the market.
The first-time investor. Or
Yeah, the first time people come in doing things, you're looking and saying, boy, we've seen and done that, what are you doing? And I think that's more hot money that's coming in and out. I think long-term healthcare real estate is going to start finding more and more of a role in core institutional portfolios. It's not going to be medical versus office. It's going to become part of the office sector. I mean, it's really becoming more mainstream. So there's huge opportunity, and I think the biggest is it's still so fragmented. It is so hard to access this space. Blackstone, all these big names that would love to get in the space, how are they going to do it? I mean, they're not going to do a $5 or $10 million deal or $50 million deal. So, you've got all this money out there that's raising tons and tons of capital. They're just not going to take the time to go kind of jump in. So the fragmentation, the opaqueness, the challenges, that's what's creating this opportunity. So I'm very bullish on the sector long-term, 100%. My concern is some of the things that people are doing are, again, assuming everything has to be perfect. And we all know that's just not the case. And so I think, you need folks that are, you need the adults in the room that have done this before, that are going to underwrite it properly, that are going to have the right partnerships. And there'll be great opportunities for us long-term. I mean, before the downturn, we didn't do much business with the REITs. In the downturn, where the cost of capital for the REITs was challenging, we JV'd with REITs. So for us, the fun thing is we look at this for the next 20, 30 years, manage our cost of capital effectively, and it's going to be a great sector.
So basically, Blackstone needs to come out and buy one of these guys and take them private, and that's how they put their money to work. And then we all go home.
That was a life science play.
That was there you go.
Exactly.
Anyway, I think with that we're gonna wrap up. So join me in thanking the panelists.
Taking time out of your busy schedule to be here. We appreciate it. We're going to have a coffee break right outside, and our breakout sessions will begin at 10:15. Thank you all for being here.